What if the expert you trusted the most suddenly told you the exact opposite of everything they once believed? Because one of the biggest voices in investing just flipped their entire strategy, and it could change how you see the market forever.
Welcome back to The Explainer. Today, we're digging into something that has the whole market buzzing. What happens when a top market guru, someone famous for their absolute unwavering belief in the Indian growth story, suddenly does a complete 180? Yeah, we're talking about a massive pivot that's left a lot of their followers wondering what to believe. So that's really the big question, isn't it? How does an expert go from preaching all in on India to advising people to start looking elsewhere? We're going to deconstruct this whole reversal to understand not just what happened, but maybe more importantly, why it happened. Okay, so to really get how massive this shift is, you first have to understand the original doctrine. I mean, for years, this commentator's entire brand, their whole identity, was built on this unshakable, almost religious faith in the Indian growth story. And the central pillar of this whole belief system was a really simple, catchy acronym, BAP, which stands for buy at any price. The argument was pretty compelling, you have to admit. The idea was find a great Indian company and just buy it. Don't even sweat the valuation. The thinking was that the sheer power of India's growth would eventually make even a super high entry price look like a bargain down the road. And the playbook for this was incredibly focused. Rule number 1, India first. The focus was always on domestic growth stories. Rule 2, ignore all the global noise. All that macroeconomic stuff was just a distraction. The real action was at the company level, the micro. Indian founders were constantly praised as the best value creators on the planet, and the Indian banking sector, that was treated as the unshakable foundation of the entire thesis. And then the entire philosophy just imploded. And look, this wasn't some slow, gradual change of mind. It was a sudden, seismic pivot that sent absolute shockwaves through the investment community. And here's the bombshell number that tells the whole story. A full 50% of this person's portfolio has now been moved outside of India. And this wasn't just a quiet, personal move. It was a public call to action, basically urging followers to sell their Indian assets and look abroad. I mean, it is hard to imagine a more definitive reversal than that. So what on earth could cause such a fundamental U-turn? Let's break down this flip, piece by piece, and look at how each core belief of the old philosophy has been completely turned on its head. First off, that buy at any price mantra, it's dead. It's been replaced by a pretty stark warning that Indian valuations are now dangerously stretched. That's a huge signal that the era of easy returns might be over. Next up, that ignore the macro rule, completely abandoned. Now there's a newfound admission that you actually can't ignore the bigger picture, that broad economic forces, the macro stuff, absolutely do impact individual companies. The hero of the story has changed too. The celebrated Indian founder has been replaced by what are now being called more mature businesses in the US and Europe. That's a pretty clear signal that the focus has shifted away from high growth and towards perceived stability. So you see how all these individual reversals are building into a completely new investment thesis. The focus is no longer about chasing growth. Now it's all about managing risk. And the main justification for this entire pivot is macro risk. Yep, the very thing investors were told to ignore for all those years. But here's the thing, this isn't some vague global fear. The risk we're now being told is coming from inside the house, the Indian financial system itself. This table really lays out all the new fears. You see, the banking sector, which was once the crown jewel, is now being presented as a major liability. The concerns pinpoint potential stress in lending, a rising risk of non-performing assets, which is just bank speak for bad loans that may never get paid back, and of course, the fundamental danger of having all your eggs in one basket. So the new plan is basically a 4-step retreat. First, acknowledge the high valuations. Second, sell a portion of your domestic Indian holdings. Third, reallocate that capital to US and European markets. And fourth, create a balanced India plus global portfolio. The message is crystal clear. The all-in on India party is over. This massive reversal leaves the average investor, someone who may have been following the original advice for years, standing at a very, very confusing crossroads. You've got two completely contradictory roadmaps from the exact same source. And this leaves you, the investor, with a really difficult choice. Do you follow the expert's U-turn, or do you trust the original compass that guided you here in the first place? It raises an even more fundamental question about market gurus themselves. When the storyteller changes their story this dramatically, do you follow the new narrative, or do you start to question the storyteller? That's the real takeaway here.
Because maybe the real lesson isn't about India or global markets. It's about this. Blindly following anyone in investing is the biggest risk of all. If you want to learn how to think independently instead of following the crowd, hit subscribe now. Because in investing, the best strategy is the one you truly understand.